Good morning, everybody. Welcome to our brunch bites. This is after a long layoff. This is a return to our quarterly breakfast bites updates. Normally we have a nice little breakfast in the Truro office and talk about something of a tax technical nature. Had a bit of a break because of the COVID, but I finally bitten the bullet and gone for the new technology. This is my first webinar, so apologies if the technology is a bit clunky. I've got a good team supporting me, but it's not something I'm a natural with, but hopefully it'll go well. The subject today is not another SDLT surcharge, referring to the new 2% surcharge in addition to the 3% we already have, which is coming in April 2021. I'll run through the detail, and at the end, I can take questions. There's a button, as if you're not familiar with Teams, there's a button on your screen with a little question mark in a sort of a speech bubble, and if you click that, you can type in your question. You can do so anonymously, or you can leave your name. It's up to you, and we'll go through those at the end. The session will be about an hour. I believe we're recording it, so hopefully you'll be able to see a rerun later if you want to. And I think that's it. I think we can get stuck into the detail now. That's giving people latecomers time to join in, and it feels most odd. Normally I can see everyone and know what's happening, but talking to a blank screen is very strange. But then, same for all of us, I suppose. So, not another SDLT surcharge. The format of my slides, you'll see various white slides, which is the technical detail, and the coloured slides are sort of my commentary. And I'll start off with a bit of background. And really, this is another layer of complexity to wreck what was such a simple tax. It wasn't so long ago. The maximum rate of SDLT was 4%. We only had to decide whether our purchaser was buying residential, non-residential, or mixed property, or buying on a lease. We looked up the rate using a slab rate, plugged in the figure, and that was it. An easy, quick and easy, just filling in a form, paying the money, and all is done. But it is not the case anymore. The tax has been made far more complex ever since George Osborne decided that he had a magic money tree, and it was called stamp duty. We've just had layer upon layer of complexity, and from 1st of April 2021, we've got a new non-resident surcharge coming in, applying to non-resident purchasers. Under this regime, the maximum rate will now be 17%. The absolute top rate of stamp duty you can pay could be as high as 17%. And you'll have to decide which of 14 possible rate scales you'll fit into. Now, you may not realise it, but we've already got 8, and now we're adding another 6 more on top of that. Now we're talking about non-resident, so you've got to decide who is non-resident or who is UK resident. And rather than using the statutory residence test, which was brought in after a lot of consultation 7 or 8 years ago, we've got a completely different residence test. In deciding whether or not our purchaser is within this, we ignore the statutory residence test, we ignore their general tax status, and we apply a totally new stamp duty residence test. And it's perfectly possible. In fact, I think it'll be quite common for a UK resident to get caught by this, and for non-residents to get away with it. Just like the 3% surcharge we already have, which really is not aimed at people buying their main residence, there will be collateral damage and people getting away with it. We've also got complications, and one of the complications is always when a trust gets involved with something. In stamp duty, we've had a trust definition, a fairly simple one. You either have a bare trust or a settlement, and the rules apply to one or the other in different ways. Well, for the purpose of this new regime, the trusts caught by it are a hybrid of the two. So a new trust definition just for this purpose. We also, having a surcharge, have a refund regime, just like with the 3% surcharge. If you pay the 2% and later you find you do qualify, you can get your money back, but it's a different refund regime to the 3% surcharge. And to cope with this, we've got a new stamp duty land tax return. It looks very much like the old one, but they've hidden some very important questions really right away at the back. On the old return, the current return, shall I say, the very first question is where you decide whether or not you're within the surcharge, the 3% surcharge. On this one, That question is at question 52, which really is going to catch people out. So let's get down to the detail. There's a single section been added to the Finance Act, and it tells us that in respect of a non-resident transaction, the rules have effect as if 2% were added to each rate specified in the rate specifying provision. So first thing there is applies to a transaction, just like the 3% surcharge. If one person of joint purchasers is caught by this, they're all dragged in because it applies on a transaction by transaction basis. And then we have to look at the rate specifying provisions. We've currently got 8 SDLT rates, 6 caught by this. And if you look at the list there on the screen, you'll see a theme. It's a residential element. Residential property, the normal table A, the additional dwellings, which is the 3% surcharge. So we add 3, we add 2 more percents. Envelope dwellings, the flat 15% that can apply in certain cases, is now a flat 17% if you're caught by these rules. Residential leases add 2%. So if you've got a lease caught by this, there is no nil rate band. It's a 2% band and a 3% band. First-time buyers of dwellings, a non-resident first-time buyer of a UK dwelling will get their reduction, but not to an enhanced nil rate band, but to a larger 2% band. And then collective enfranchisement for tenants of flats, pay flat 15% above a certain level, flat 17 now if they're non-resident. So the theme there is residential transactions. Anywhere you've got residential property and a non-resident purchaser, a great mix of residentials and residents there, we have an additional 2% to apply. And then the detailed rules are in a new schedule in the Finance Act. I know many people don't like looking at legislation, but when it comes to the 3% surcharge and this 2% surcharge, there really is no better way of understanding the system than looking at the tax. It's quite logically laid out, has a series of tests, and so nip into Schedule 9A, look at the provisions, and you will arrive at the right answer from there. And through this, I put references to paragraphs. I'm talking to Schedule 9A, the new references. So what does that give us? Well, it gives us now routinely 6 residential rates. The big blue blob in the middle is a standard table A, the normal rate we've always been applying. And to the right, as the rate, we've got an increase, we've got a 3% surcharge or a 2% surcharge, or both together, increasing the rates by 5%. We can reduce the rate if we've got a first-time buyer, but we've got to take into account now that first-time buyer might be paying 2% on top, which is worse than the standard table A, but better than the standard plus 2. So we've got 6 rates for a routine transaction. And that's before we start looking at whether we've got mixed property. It's before we start looking at multiple dwellings relief. You'll notice I've not mentioned on here the current holiday rates because they are due to end on 31st of March 2021, and these new rules are due to start the day after. So what do we mean by this? What is a non-resident transaction? If we just go back a couple, the rules apply to non-resident transactions. A non-resident transaction is one where all 4 of these conditions apply. Firstly, the purchaser is, or the purchasers include, a person who is non-resident, not resident in the UK. I'll come back to what that actually means in a moment. But then importantly, the main subject matter must be a major interest in a dwelling or dwellings. Now, a major interest is a freehold or a lease. It doesn't include a right or power in or over land. So buying an option, a non-resident buying an option of residential property would not be buying a major interest, so wouldn't be within these rules, despite the fact that he's non-resident. But a major interest is also qualified. It's not treated as a major interest for these purposes if the actual interest is a short lease, a lease with less than 21 years or less to run. So you're not going to find that every assured short-hold tenancy is caught by these rules because they're by definition short leases much less than 21 years. But nor will this be caught if you're buying a property subject to a lease with a tenant in situ with more than 21 years to run on their lease. So if you're buying a property, paying a premium for a property with a tenant in situ, if the lease has got more than 20 years to go, then even if the purchaser is non-resident, it's not within these rules. And one of the problems one of the most common questions I get about the 3% surcharge is people getting hung up on the fact that someone's got other property, forgetting the fact that that surcharge 2 requires 4 conditions to be in place or it doesn't apply, no matter how many properties that person has got. And this is exactly the same. It's not all about condition A. Conditions B, C and D are also important. I skipped over D because we're not going to come across it very often. Chargeable consideration is 40k or more. Of course, it's going to be that in almost every case. But it is of the purchase, not the non-resident's interest. So if you've got 2 buyers, one's non-resident and one is resident, you're not looking at their share in judging the 40,000. You're looking at the total 40,000. Now, the first question on that list was a person who is non-resident. What does that mean? Well, before that, let's just throw, I forgot, we've got this little paragraph 3 in here. I had to put this in. It's barking. Let me read it out. For the purposes of this schedule, an individual is non-resident in relation to a chargeable transaction if the individual is not UK resident in relation to the transaction. What does that mean? It's nonsense. Let's move on. Now, we do not look at the statutory residence test. We're not deciding whether someone is resident for income tax purposes or capital gains tax purposes or inheritance tax purposes. We're looking at stamp duty land tax alone. And for stamp duty land tax, a person is resident if they are present in the UK on at least 183 days, that's 6 months, during any continuous 365 days, a year obviously, within the relevant period. And the relevant period is a 2-year period starting 364 days before the effective date of the transaction and ending 365 days after the effective date of the transaction. So we've got a 2-year window, 1 year either side of the purchase, and we look at our client or whoever, and we say, were they present in the UK for 6 months within any single continuous 365 days within that 2-year period? So they could be resident on the day of purchase if they were present for 6 months of the year beforehand. They may not be, but they can earn it afterwards. And there we get into our issue of later refunds if the status changes. Presence in the UK is simple. Where were you at the end of the day? So in effect, count the number of UK midnights within the period, and that tells you whether they're present here or not. Because we've got a 2-year period, half of which is after the effective date of transaction, we're going to be forecasting. And a person may, but we're told that if a person has not achieved UK resident status by reference to the period up to the date of submission of the return, then for the purposes of the return, we must assume they will be non-resident for the remainder of that post effective date of transaction period and pay the additional 2%. And if they then later earn their UK resident status, we then go in and amend the return. Now, to amend a return, normally you've got a 1-year deadline from 14 days after the effective date of the transaction. But for this purpose, because that takes us almost right up, takes us right up to the end of the possible qualifying period, we get an extra year. And the deadline for amending the return for this purpose is 2 years from the date of the transaction, from the effective day. Unfortunately, amending the transaction doesn't mean sending in a simple form online like we do for the 3%. We have to amend the return the old-fashioned way, which means writing a letter to the stamp office, sending a copy of the original return, the contract, the transfer document, quoting the reference number, explaining why we're amending the return. It's a cumbersome process. It's going to be costly. It's not going to be a simple 5-minute job like it is for the 3% surcharge refund. Now I tried to sort of put this into graphics by way of these diagrams. Now we'll give it a go, see how it works. The dotted line down the middle is the effective date of the transaction, and this slide represents the passage of time from left to right. The blue bar across the top is our relevant period, the 2 years, 1 year before and 1 year after. The yellow bar is the qualifying period, the 12 months, a continuous 12-month period, and the pink and red bar is time in the UK. And what I'll try to show is the first one there, someone's arriving in the UK. This is a non-resident who's arrived in the UK, bought a house. He arrives in the UK before the effective date of transaction, and in this case, He's here for 6 months beforehand. So at the date of the effective date of transaction, he qualifies. He doesn't have to pay the 2% surcharge. But as someone who's coming into the UK, maybe only been here for 6.5 months, he might not actually be tax resident for income tax purposes, but he meets the qualification criteria here. He doesn't pay the surcharge. The second one down, very similar. He arrives before the effective date transaction, but he qualifies afterwards. He's not been at the effective date. He's not been here for 6 months, so he has to pay the surcharge, and he gets a refund. Again, he's probably not tax resident at that point, but he earns it afterwards. And it all makes sense. He's coming here. He's going to be UK resident. It's fair that even though he has to pay it up front, he gets it back, and he pays normal UK rates. And the third one is just someone who's arrived afterwards, and he's arrived after the effective date transaction, and he doesn't earn his status until afterwards. Very similar. That all makes reasonable sense, but if we then move on to a couple of sort of oddities. Oops. Getting a bit cluttered now. The fourth one down starts the word leaver. This chap's been in the UK for a long, long time, but he's leaving and he's not going to come back. He leaves a few months before the effective date transaction, and he's not intending to come back. But he's been in the UK for at least 6 months of that year beforehand, so he doesn't have to pay the surcharge. Now, why is he buying a house if he's leaving? Well, maybe he's buying an investment property, but whatever. He's left the UK with the intention of not being resident. At the effective date transaction, he is not resident, and he will never be non-resident again. But he doesn't pay the surcharge because he qualifies under these oversimplistic rules. Not fair. Doesn't make sense, but those are the rules. The next one down is someone who's got his dates wrong. He's coming into the UK, he arrives here, he buys a house, he lives here, but he keeps nipping abroad. He's gone back to his place abroad for too long. And while he may be intending to come back and stay, if he doesn't count his days properly, and he doesn't get at least 6 months of residence in that period after purchase, then he could find himself being UK resident, arriving with the intention of being UK resident, paying the surcharge, but not getting a refund. And the last one is a long-term UK resident. Now, this is someone, I've actually got someone in mind for this. It's a client of mine who could well be in trouble if he buys another house. He's born here, brought up here, as English as you or British as you or I, but he works abroad a lot. He works in the oil industry. So he goes out to Malaysia and he works a month on and a month off. When he's a month off, he sometimes comes home, sometimes he doesn't. And it's quite possible, although he is a UK citizen, although he's always lived in the UK, and all he's doing with this transaction is replacing his current house with a new one, his day counts are wrong. Unless he makes an effort, he will pay the surcharge and he won't get the refund. A little note at the bottom of the slide, check status as spouse. I'll come back to that in a minute. There is a let-off for this chap, as long as he's married or he's got a civil partner. So it's complicated and it's unfair. There's going to be collateral damage. There's going to be people getting away with it. How about an example of the other complication, the interaction of the two surcharges? So imagine it's now mid-April 2021, and Lewis has been living in Monaco for 5 years in a leased apartment. He's got 25 years to go on the lease. He intends to return to the UK permanently, has found a suitable house, costing £1 million. He spent a month in the UK looking for a home in January, February 2021, but has not been in the UK for any significant period apart from that since 2019. He actually returned to the UK permanently on 1st of April, and its completion is expected on 1st of May. The sale of his Monaco flat has been agreed and will complete on 1st of August. What's the tax situation? Well, standard residential rate, no surcharges, on a £1 million property would be 43,750. But he's got an additional property. He's got a flat, shall I say, in Monaco. It's foreign, but it still counts. So he's got to pay another 3% on top of that, another 30k on top. But he's also not resident at the effective date of transaction. so he's got to pay another 2% on top of that. So on the 15th of May 2021, he will pay £93,750 of SDLT. Come 1st of August 2021, he sells his Monaco flat. That means that the new property is now a replacement main residence within the rules, and he can make his claim for a £30,000 refund. He's got until 31st of July 2022 to do it, and it's a simple online form. Then 1st of October 2021, he's achieved his 6 months in the UK, and he can amend his resident status and get another £20,000 refund. Deadline 1st of May 2023, but it's a fairly complicated refund. He's got to do a letter and send lots of enclosures in with it. All to get back to the £43,750 that he was expecting to pay, bearing in mind this is going to be his only and forever home in the UK. And when you think how much most people charge for doing a stamp duty land tax return as part of just a small part of the conveyancing fee, how's this going to fit? It's a lot of risk, a lot of complication. But that's not the end of the story. As always with stamp duty, we've got special cases and exceptions. One special case is if the purchaser is not an individual. If the purchaser, or one of the purchasers, if we've got multiple purchasers, is a company or a person acting as a trustee of a unit trust scheme, is entering into the transaction for the purpose of a partnership, so the property will be a partnership asset, or is an individual who's acting as a trustee of a settlement, but not of an IIP. If any of the purchasers falls into one of those categories, the relevant period is reduced. It's no longer 2 years straddling the effective date of transaction, it's 1 year up to the date of the effective transaction. If you haven't earned, if that person, that non-individual, has not earned their UK resident status by the effective date of transaction, then they won't earn it. There's no refund process when you have a non-individual purchaser. So we've got two tests. For individual purchasers or individuals purchasing jointly, which includes beneficiaries of bare trusts or interest in possession trusts, we're looking for 6 months of any continuous 12 months in the 2 years straddling the effective date of transaction. If the purchaser is or includes companies, partnerships, trustees, apart from trustees of bare trusts or IAPs, it's 6 months of the 12 up to and including the effective date of transaction. Now that might sound complicated, but it's a lot simpler than the statutory residence test. But the bad news is it's different to statutory residence test, and it will come up with different results. Right, and then we have some reliefs. Now, the main relief is Crown employment. If a person works for the Crown, is in Crown employment, then even if their duty is to take them outside of the UK, they are regarded as being in the UK on any of those days, on any of those days that they are in Crown employment, performing duties of nature payable out of the public purse. And that also applies to the spouse. So if you've got someone in Crown employment goes abroad with the spouse and they're buying a property in the UK jointly, one of them is in Crown employment, the other one is not, but the spouse or civil partner gains the status and is also regarded as being in the UK, present in the UK on those days. It's not a blanket exemption. You work out which days were they in Crown employment, add those to the days that they were actually in the UK, and then apply the test. And if you want to claim Crown employment, you've got to do so on the stamp duty land tax return. There's a box to tick, and you claim it on the return. Similarly, if they fail to qualify and qualify afterwards, you can amend the return in just the same way. Something's gone wrong. Sorry, sticky mouse. And then the other thing we want to consider is UK resident companies. Is a company UK resident or not? And unfortunately, it's again complicated and different to the standard definition. To determine whether a company is resident or non-resident, we look at Chapter 3 of Part 2 of the Corporation Taxes Act 2009, apply that definition. We should already know that because the company will then be non-resident for corporation tax purposes. So it either is or it isn't for that purpose. But we have a further non-resident qualification. It might be resident according to Chapter 3, but if the effective date of transaction is a close company, which meets a non-UK control test and not an excluded company, then it's regarded as non-resident regardless. Just to make life interesting, close company, a long-established concept in UK tax, has a different definition for these purposes. It includes some quoted companies, and it includes companies controlled by more than 5 participators, shareholders. Some phrases in there we've got to explain. Excluded companies means OICs, UK rights, and members of UK rights, basically investment companies of various different sorts. And there's different treatment for coax, another form of investment company. But the most important part of this test is the non-UK control test. Now, I've oversimplified this because it's complicated and it's really outside the scope of this course. Essentially, abbreviating substantially, is that company controlled by non-resident participators? Participators are shareholders or people with substantial loan capital. But for a closed company, normally we say, is it controlled by 5 or fewer participators? For these purposes, we just say, is it controlled by non-resident participators? So we don't have the 5 limit. And we also have to be careful because we have to attribute the rights and powers of people connected with them. The trouble is that because this falls part of the alternative test, every time we've got a company purchaser, we've got to be comfortable that it isn't caught by this non-UK control test. So if you have a company purchaser, you've got to ask the question, are there any non-resident participators? If there are, well, you've got to start digging deeply and working out who controls, how many there are, and whether this actually overrides the corporation tax status of the company. I could talk, my colleagues could talk all day about non-resident companies. It's too involved for this session. And then we have a number of special rules, exceptions, if you like, in most cases. And one really useful one, the one I mentioned talking about my oil company client, is a UK resident spouse purchasing jointly. So you've got husband and wife or civil partners who are living together on the income tax definition of living together. One is UK resident and the other is not. In that event, both are deemed to be UK resident. The fact that one spouse is UK resident overrides the non-resident status of the other. And that gets, or it would get, my client off the hook if only he were married. Unfortunately, he's divorced, so it doesn't work for him. Well, what I mean by living together, the income tax definition refers to someone who is married or a civil partner and not separated in circumstances likely to become permanent. So they might not be living together as in one's abroad for half the year and one's not, more than half the year in fact if they're non-resident, but they're living together in that they're married and not intending to end that marriage. That's a really useful exemption, but do be careful. It does require them to be purchasing jointly. It doesn't give the non-resident spouse the ability to buy a property in their own name. They've got to buy it jointly with the resident. And then for trusts, I mentioned that we've got this alternative definition. Normally, we are asked the question is, do we have a bare trust or do we have a settlement? A bare trust is a trust where the beneficiary has an absolute right to occupy the property or to the income arising from the property, an absolute right against the trustees. A settlement is any other trust. An interest in possession trust, one where a life tenant has a right to occupy for their life, and then on death, the capital, the property goes somewhere else, is a settlement normally. But for the purposes of the non-resident test, we treat a settlement as if it were a bare trust. And the resident status follows that of the beneficiary for a bare trust or IAP. So it doesn't matter if it's an overseas trust, if the beneficiary is UK resident, despite the fact the trust is buying the property for the benefit of the beneficiary's UK status overrides that of the trust. For a settlement, it doesn't matter where the beneficiary is located, it's all about where the trustees are resident. We have exceptions in normal stamp duty for alternative finance, or Islamic finance is often called. And Islamic finance, rather than paying interest, the borrower buys the property and gradually sells it back to the borrower. For alternative finance, the status for this purpose, it depends on where the borrower is, whether they're resident or non-resident, not the financial institution. Quite often these are actually banks in the Middle East. So they will all certainly be non-resident, but it's where the borrower is situated that affects this. Then we have substantial performance. Substantial performance is what decides what the effective date of transaction is. Now, normally with stamp duty, the effective date of transaction is the date of completion of a purchase. But if you substantially perform a transaction beforehand, that's the effective date. And substantial performance is occupying the property or paying at least 90% of the consideration. In the event of substantial performance, the earlier transaction, the substantial performance will set the resident status. You determine that's when that's the end of your first qualifying year and the start of your second qualifying year, and the eventual completion has no effect on it. And then we have these coacs where coacs are treated as not non-resident unless they're in a European Economic Area scheme. I can't tell you more than that. I haven't got a clue what a coac is, apart from that it's some sort of financial services entity. Right, we're on in the final straight now. We have a new stamp duty land tax return, same as the old return, but we've got an expanded question 52 to deal with this non-resident issue. Question 52, right back at the end. This is where we actually deal with a number of purchases. How many purchases do we have? And in amongst that, there are 3 additional questions, easily overlooked. If you've only got one purchaser, you just skip over this and move on. But there are 3 additional questions. They're simple yes/no answers, but be careful. That first question is loaded. The second question is not much better. Our first question, are any of the purchasers non-UK resident? Yes or no? Are you sure? You've got to find out. You've got to ask them. But not only have you got to ask them, but as we'll see in a moment, you've got to ask them the right question. Are any of the purchasers a UK resident close company controlled directly or indirectly by non-UK residents? That's an easy question if none of your purchasers are UK companies at all. But if any of your purchasers are UK companies, that question could be tricky and you've got to ask further questions. The last one's an easy yes/no. Are you claiming Crown employment relief? Do you have a Crown employee who's trying to argue UK resident status by way of their overseas duties? So when you're talking to your client, trying to determine what rate of tax applies, the one question you should not be asking is, are you UK resident? What answers are you going to get? Yes, I'm a UK resident. I live here. Yes, I have the right to live here. Yes, I'm tax resident. None of those actually answer the question. They could answer yes to all 3 and still be non-resident. They could answer no to all 3 and yet be UK resident. The question you should be asking is a little more complex. Have all joint purchases been present in the UK for at least 183 days in the 365 days up to the effective date of transaction? And if the answer is no, you've got a supplementary question. Are they close? Will they have been within 14 days? Because what you can then do is hold the return back until they qualify and send the return in then, but you've got to send the return in within 14 days. So you've only got 14 days of grace there. Does the Crown exemption relief apply? Or does the UK resident joint purchasing spouse exemption apply? Even if they say no, but we will be shortly, if they don't meet the condition within a year if they don't meet the condition at the date of the effective date of transaction, at that date, they must put non-resident on the return, must pay the surcharge, and then they're into the refund regime in due course. Oops. Other points, non-residential property or mixed property. Well, those are taxed under Table B. They are not. Table B is not a listed rate specifying provision. They are not enlisted on those six rates mentioned back in section 75 ZA at the start of the session. They're not there. So a non-residential property or a mixed property purchase will not be caught by this additional 2% surcharge. If, on the other hand, you've got mixed property and you make a multiple dwellings relief claim, your mixed property includes more than one dwelling, and you're trying to get into the lower rates, the extra nil rate bands, then it currently appears non-resident surcharge will apply to the dwellings. Now, I say currently appears because we've long held the view that in that circumstance, the additional properties surcharge, the 3% surcharge, does apply. But just in the last few weeks, the revenue have backpedaled on that, and it appears that it may well be that multiple dwellings relief doesn't impose the surcharge in this circumstance, and we just need to be clear as to whether that's going to also apply in this case. Currently, it appears that it does. We're expecting a possible legislation change, maybe in the next budget, to clarify all this, and it would seem odd if the two rules would remain different in the way NVR applies. Similarly, if you buy 6 or more dwellings in a single transaction, all residential, the fact we've got 6 or more dwellings takes us out of Table A into Table B. Table B is treated as mixed property or non-residential property. It's not a listed rate specifying provision, and so the surcharge does not apply even if the buyer is non-resident, again, unless we claim MDR, again, with that qualification already mentioned. The definition of dwelling for the purpose of this surcharge is exactly the same as for multiple dwellings relief. It includes off-plan purchases. And the whole thing is fixed on completion date or substantial performance date if earlier, and we have a transitional rule. If you exchange contracts before 11th of March 2020, this year, 8 months ago, but complete after the start date of the regime of 1st of April 2021, you won't be caught by the new rules, provided the contract is utterly unchanged in that period. In reality, such a long period, that's over a year of being on contract but not completed. It seems unlikely the contract will be completely unchanged in that period. But if you have that situation, the surcharge will not apply. So, wrap up time. What do you need to watch out for? And really, this surcharge is full of danger. It's complicated, it's illogical, people will get caught out. First off, an easy one, non-resident or non-residential, two very similar phrases, don't get them mixed up. It's unfortunate they sound so similar, rules are completely different, different surcharges apply. We're going to be tripping over our tongues, but that's a minor point. More seriously, we are seeing a lot of incorrect stamp duty land tax returns. I see them because I pick up pieces when the revenue come calling. I'm also seeing a lot of missed opportunities for relief claims. I come across a lot of cases where people are contacted by these ambulance chasers, I call them, who say, "Are you sure you paid the right stamp duty? Would you like to sue your solicitor, or would you like us to help you get your refund and charge you a fortune for doing it?" We're seeing a lot more HMRC inquiry activity. They're particularly at the moment looking at mixed property claims and multiple dwellings relief claims. The result of all this is conveyancers are being sued. We're seeing them being sued for incorrect returns, and we're seeing people trying to sue them, whether they're successful or not, I don't know, for failing to bring issues to the buyer's attention. Now, most conveyancers will have small print disclaimers saying that they don't give stamp duty land tax advice, and most people I'm now seeing fairly good questionnaires shifting the liability off the conveyancer onto the client to seek advice from a specialist if they can. But they don't work if the return is wrong in the first place. It's all very well not claiming something that should be claimed. It's all very well preparing a return based on information given. But if you actually do the return wrong, which happens a lot in the 15% surcharge, but can equally happen here, if you're not asking the right questions, if you're not taking notice of what you're told, then I don't think that a conveyancer will have a leg to stand on if the return is wrong and the opportunity to get a refund is gone. I'd also warn you, the online HMRC SDLT calculator is very limited in its usefulness. It's very good for routine cases, but since we've had these complexities in stamp duty, it really is a very limited use. It's just a tool, it's not the gospel. Putting your figures in the calculator will not get you off the hook if the answer is wrong, because it does not take into account all the complexities and the opportunities that are around. And lastly, don't forget, this additional 2% surcharge, unlike the 3% surcharge, applies to leases too, residential leases. So that's the end of my session. I'm going to drop out of this screen now and see if anyone's been asking any questions on the way. I have 2 questions. With all the noise surrounding potential rises in capital gains tax and the fact that it has been pointed out that from the previous experience that rises don't actually contribute to increased tax collection because people change their decisions, are there any projections on what the government expects to achieve from this SDLT surcharge? I'm sorry, I have not a clue on that one. It's all part of a trend we're seeing of increasing the tax on non-residents. If you look at the UK tax regime, historically, UK residents have been taxed a lot less than UK residents, and we're seeing over the last few years a shift in the other way on that, and I think this is part of it. And I think that given that, even if this does not contribute significantly, then I think as a policy decision, it's making the right noises as far as the government's base is concerned. But I think it probably will increase the tax take. There are a lot of people who are non-resident who invest in the UK. The property market is still booming, so I think there's still going to be non-resident investment, and this is an opportunity to raise money. And I don't think we can also ignore the number of people who are going to be caught by this who probably shouldn't. So I haven't got any figures, but I don't think that we're going to see a U-turn on this. And the other one, anonymous question, not really a question, but I suppose it's key that people speak to their solicitors and their accountants before taking action. I couldn't possibly argue with that, could I, really? I don't think we've got any more questions coming through. Okay. Well, thank you all for joining me today. I hope that was useful to you. We've got another 4 months before the regime starts, so there's plenty of time to get your thoughts together and to research it further. One of the key things is thinking about how you're going to address it. If you're involved with the public on these, then think, how are you going to address this? How are you going to get the right information for your clients to make certain that you're not left exposed if the returns are incorrect, if they're not telling you the right thing? There will be further information on our website. We have a knowledge base on there which is really getting quite detailed, covers a lot of different taxes, not just stamp duty. We've got specialist areas on COVID and Brexit, as well, and property taxes in our various different sectors. And if you have a question, it's worth looking in there and seeing whether we've covered it, or it may lead you to further information. And knowledge bases often have further links into other areas. They're a good first reference for you. I'm trying to think what else I may have forgotten. We will be distributing the slides to people later. And what have I forgotten? I think that must be it. We're a little bit ahead of schedule. I'm doing my usual fast talking. So I will close now, and thank you all for joining us, and hopefully we'll see you on the next session. Thank you.